Good morning and welcome to today's webcast, Not-for-Profit Tax Update, Expense Allocation. Before we begin, I'm going to play a brief housekeeping video.
Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize both how you view our presentation and how you interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the file folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy Webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, in order to receive CPE credit, you must complete our attendance sheet, available in the file folder icon at the bottom of your screen. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. We'll email a copy of your PDF certificate in 2 weeks if you can't download it today. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Welcome everyone, and thank you again for joining us today. I'm happy to introduce today's Moss Adams presenters: Chauna King, Tax Manager; Darren Lowe, Tax Director; Paul Hoberg, Tax Director; and Sasha Correnti, Business Assurance Senior Manager. Chauna, I will now turn the line over to you to get us started.
Thank you, Emily. Okay, I'm going to start off with a brief overview of the agenda for today's webcast. We are going to go over functional expense allocations, what they are and why they are important. I will touch on unrelated business income. Paul and Darren will go over transfer pricing, what it is and how it's applicable to nonprofit organizations, and then they will go over some allocation examples. And Sasha will end the webcast with Accounting Standard 2016-14, and then we will have some time for some questions at the end. I'm going to start off with our first polling question. What type of organization are you representing? I will give you a few minutes to respond. And here is the answer to our first poll. Okay, functional expense allocations. Why is it important to allocate functional expenses? There are many different reasons to allocate expenses, and it's important. It can help organizations manage costs for certain programs and evaluate continuing programs or if changes are needed. Some donors also may require a specific percentage of costs related to program services, and some costs of fundraising and operations that aren't directly related are an area of concern. Both GAAP and the Form 990 require expenses to be broken out. It can allow to benchmark different programs against other similar not-for-profit organizations, and it can help to accurately calculate UBI expense to offset income subject to tax. The FASB accounting standard codification requires not-for-profit organizations to report expenses by functional classifications. Presently, only voluntary health and welfare organizations are required to have a statement of functional expense in their financial statements. However, Sasha will go into more detail regarding the changes related to the accounting standard updates later in this webcast. Functional expenses, direct versus indirect. Direct expenses can be specifically identified with a program or support service, such as grants, scholarships, teacher salaries at school. Indirect expenses are the costs that benefit more than one project or activity and are not readily available and identifiable with a particular project or function, such as depreciation and office supplies. There are two different types of classifications for expenses. Natural classifications tell us what was purchased, such as advertising and accounting fees. Functional classifications tell us why an expense is incurred. Functional classifications are grouped through program services and supporting activities that allow for general administrative and fundraising breakouts. It is important to note on tax purposes that only 501c3s and C4s are required to break them out on the Statement of Functional Expense on the 990s. Paul and Darren will delve further into how to utilize transfer pricing to allocate expenses among the three functional classifications. Program service expenses are expenses that are directly related to the organization's mission. These are activities that result in goods and services being distributed to beneficiaries and customers and fulfill the purpose of the organization. These can include grants, medical supplies for certain welfare organizations, conferences, etc. Program service expenses generally constitute a majority of the total organization expenses. Supporting activities include both management in general and fundraising activities. Management in general are activities that are not easily identifiable with a program or fundraising activity, but are indispensable to the organization. These may include accounting, general management and oversight, audit, occupancy, communications with the public, and other such expenses. Fundraising expenses are those activities that involve inducing potential donors to contribute, publicizing and conducting fundraising campaigns, maintaining donor lists, conducting special events, and other such items. The financial statement should disclose total fundraising expenses. There are general guidelines and schools of thought out there regarding how much % of expenses an organization should spend on program. It's between 60 and 75% that it has been considered a best practice for organizations to spend on program services. States have tried to establish laws specifying required allocations, but they were struck down by the Supreme Court as unacceptable restrictions to the organization's rights. It is also important to note that the IRS recommends if an organization is publicly supported that they should have at least 5% of fundraising activities. We see many common pitfalls when it comes to expense allocations. Often, public charities are not reporting any fundraising expenses. They are not allocating occupancy and depreciation. We also see that some organizations allocate a fixed percentage of costs rather than true costs, which can under or overstate activity revenue. Often, there's a lack of documentation that allocations are reasonable and that expenses are consistent with exempt purpose in other similar organizations. Most importantly, improper allocation of expenses to unrelated business income is a huge area of interest, and I will go into further in the next section. There are 3 requirements to be met for an activity to be considered unrelated business income. The first requirement is a trade or business aspect. This means that the organization has to conduct this activity for the production of income from selling goods or performing services, and generally a profit motive is involved. The second aspect is regularly carried on. This means that activities are regularly carried on if they are continuous and frequent. Even if an event is only held annually, it can still be considered regularly carried on if it involves significant planning, preparation, and time prior to the actual event for an organization. The last requirement is that it must be unrelated to the exempt purpose. In general, to calculate unrelated business taxable income, you take gross receipts from the unrelated activity, and you take out any direct expenses that are proximate and primary to the activity. Then you can allocate indirect expenses by using a reasonable and consistent allocation method. It is important to note that there are some exceptions to the general equation for calculating unrelated business taxable income. Exploited activities, dual-use facilities, shared expenses, and loss activities all take further investigating and researching to note what expenses can be expensed, as not all expenses may be deducted. In 2016, the IRS had nearly 5,000 examinations, and 611 of them were related to unrelated business income of exempt organizations. They noted that the items of review were gaming, non-member income, expense allocation issues, non-operating loss adjustments, rental activity, advertising, debt finance, property rentals, and investment income. Because of the large amount of success with this plan, the 2017 plan for the IRS has included a new 990T case selection model for review, in which they will implement data-driven case selection with the goal of identifying and addressing the high-risk areas of noncompliance previously noted. It is also important to note that now that 990Ts are available on GuideStar for public inspection for certain organizations, more scrutiny has come involved. The AICPA has recognized that there was a lack of guidance regarding expense allocation from the IRS, and they have gathered a panel of practitioners. One of our tax NFP partners has been on this panel, and in February of this year, they sent a letter to the IRS discussing guidelines for examples in IRS consideration when addressing how to allocate UBI expenses. Some of the main important issues that they requested were suggesting that deductible expenses include both direct and indirect expenses, suggest that methodology for allocating expenses for dual-use facilities can be based on the character of the expense involved. For example, facility costs should be apportioned based on the portion of the facility used for the unrelated business activity, and personnel and IT and office expenses can be apportioned based on the allocation of time spent or personnel involved for the activity. The AICPA did recommend that the IRS permit the use of gross revenue from each respective activity to allocate expenses if there is no difference between unrelated versus related revenue, which would make it easier for organizations to control. They also noted that the IRS should provide a simplified method for small businesses because they often lack resources to properly document actual expenses incurred related to unrelated business activities. I will now hand it over to Darren to talk about transfer pricing.
All right, thanks, Shauna. So now that we've discussed some of the basics in terms of functional allocation and then the UBI, I'll now touch on transfer pricing and what is it. And often, some of the thoughts that I often hear is, oh, transfer pricing is an international issue, or it's something that doesn't necessarily happen with single entity or not-for-profit entities. But as you'll see later on with the examples that Paul will cover, is that it really is a major issue, and as Shauna mentioned, is the focus of the IRS. So firstly, based on our experience is that, there's varying degrees of experience with transfer pricing. So I'll start with the basic definition. So here we have on the next slide, this was a definition that was derived from the Joint Committee of Taxation. And as you'll see, it essentially discusses transaction between related entities, and that is based on market conditions. However, this original definition was derived from the Joint Committee on Taxation for transfer pricing and possible income shifting into international contexts. So it actually was discussing countries and different jurisdictions. However, we've actually kind of adjusted the definition to encompass all of the taxable entities and non-taxable entities, because it really does affect non-taxable entities as much as it does on taxable entities, and also from a local and I guess a federal point of view, as also from an international standpoint. One of the major items that the IRS has focused on is these multinational corporations shifting income, but we've seen more and more focus on not-for-profit entities and partially exempt entities, because there is, very little guidance out there in terms of what one should do. So with that, going on to the next slide, we'd look at the basic U.S. transfer pricing principles that one must follow in terms of the expense allocation. And what's important here is that typically when the rules were written way back in, I would say, the 60s, and probably what has attributed to that rule is probably even before that, it applied to tangible property. But as one can imagine, as we've moved into more technology and different types of service industries, it now obviously affects services. You can look at loans, especially with a lot of more internet companies. There's a lot of intangibles, licenses, and royalties. And there's also questions around leases and rents. And clearly what we have here is cost allocations. And what's important is that one must follow the arm's length standard. And essentially what the arm's length standard says is that you must transact in a way that's consistent in the similar way that which third parties would transact that. So that would a willing buyer and a willing seller accept the price? And in this case, if we were to allocate cost, would it be a fair allocation of cost? Also, things to note is that we must follow the best method rule. So the best method rule says that we have to choose a reliable measure to achieve an arm's length result. And some of the things that it states in Section 482 is that you must have comparable transactions under comparable circumstances. So therefore, if you're using a price that a third party is using, it has to be under the same, obviously, market conditions. It has to be the same payment terms. And on the last point there, we talk about an arm's length range. Often transfer pricing is considered, in many respects, an art as opposed to a hard science. And we often come up with an arm's length range for prices because there is varying degrees of situations that could apply. So on the next slide here, so then how does that really apply to not-for-profit entities? And as you can see, probably we'll start with the table. It really does apply to all situations except for when there's two fully exempt entities. So obviously, the status of a not-for-profit doesn't itself determine its taxable status. It's rather its mission, either for charitable, religious, or educational reasons. And then generally, it will fall into one of these three categories. So as we can see, there is it often applies to many situations. And as Paul will later go into the examples, you'll see some good, there's also opportunities for transfer pricing if we are required to allocate expenses. Obviously, it's in the best interest of the entity to do it most tax efficiently. So now here we have our next polling question. So the question is, what is your organization's tax profile? We have all activities. Entities are fully exempt. We have single entity with UBI. Multiple entities, some exempt and some are at least partially taxable. All entities are fully taxable, or none of the above. So we'll give you some moments here to answer the polling question. All right, it's coming on to 10 seconds here. Have to close the poll. And here are the results. So just moving along now. Cost allocations. So essentially, cost allocations have to be done in a way that is reasonable. So there is actually no firm guidance as to what is considered reasonable. As we can see from the first point there is often transactions that take place in the not-for-profit world that is not considered an actual transaction. So that may happen with loans or rents. in license and royalties, or even some services. So, for example, if you have a centralized HR function or centralized IT function, we have to come up with some sort of reasonable allocation method to allocate those expenses. So I think the general guidance with this is that it should be consistent with the utilization of the resource. So if we estimate that the IT function is 30% based on how it's used, then that could be an allocation method, and this is ideally, it should be documented, and the way upon which the method was derived should also be documented, and that's something that the IRS has been consistently challenged. And Paul and I have seen where there was an allocation to a for-profit entity, and the state authority essentially was denying the deduction because they never had a strong documented methodology. So ideally, we do have this cost allocation methodology documented, and we have a basis for it. And then going on to the next, what you will see with Paul, he'll go through some good examples about situations where this occurs. So moving right along, I hand it over to Paul with some good allocation examples.
Okay, Darren, thank you very much. Before we do that, I do want to point out one thing on Darren's last slide, and that is we talk about transactions, and I think it's key to emphasize that, yes, you may have an actual transaction where your taxable entity receives services or a loan from a non-taxable entity, for example, but also we're talking about situations where there is not an actual transaction, and what I mean by that is you have situations where the one entity or one business will borrow money from a third-party lender, and then you're allocating the interest cost among the various activities. So you may think you don't have transactions, but in fact you have what effectively amount to transactions. Now I'm going to go over some examples of allocating these indirect costs in three what were real-life situations for our clients. The first example, we have an entity that owns and operates a network of retirement communities, senior housing centers, and home health care organizations. All of this entity's activities are related to its exempt purpose, which is to create and enhance lifestyle opportunities for senior citizens. So it ends up being fully exempt from tax. And it just so happens that this entity has a full administrative staff that does all of the back office work, like human resources, IT, accounting, and so forth. Now, over time, this exempt entity realizes it has some unused land surrounding one of its retirement communities, and it wants to take advantage of that land. So it ends up setting up a subsidiary, and that subsidiary owns and operates a golf course that it builds. Also, one of the buildings that the parent company or parent organization built for use as a retirement home didn't sell very well, so they decided to repurpose it into a hotel where the families of the people resident in their retirement communities could come and stay during visits. So it sets up yet another subsidiary to own that hotel. Although both the golf course and hotel make the nearby communities more attractive to potential retirees, they don't specifically relate to the organization's exempt purpose, so they're both fully taxable. Now, these taxable entities don't have any administrative personnel, so the exempt parent entity performs all of their back office administrative functions and charges the taxable subsidiaries for the back office administrative services. So now let's look at the numerical impact of this. In the top section of the slide, you can see the income statements for each of the entities before any intercompany charge or cost allocations from the parent entity. On this basis, the group would end up having a tax liability of about $840,000. Now, if you go to the bottom half of the slide, the addition of an intercompany services charge, cost allocations, effectively shifts deductions from the tax-exempt entity where they're effectively wasted from a tax perspective to the taxable entities where they can be used to reduce the amount of income subject to tax. Now, in this example, there was a savings of about $735,000. And assuming the allocation of the parent organization's expenses for the administrative functions are supportable and well documented, the group is certainly in better shape with the addition of these intercompany service charges or cost allocations. Now let's take a look at another example. This one is in the medical or healthcare industry. We have two not-for-profit entities that were set up by a group of hospitals in a major metropolitan area. Both of those entities provide medical testing services, anything from your standard cholesterol checks to cancer screens and employee drug testing. Now, Entity 1 provides medical testing services to commercial entities and to the general public, and therefore it ends up being fully taxable. The second entity performs the same testing services, but it does so for the group's member hospitals. And since those member hospitals are themselves tax-exempt entities, this entity number 2 in our structure is considered to be fully exempt from income tax. Now, each of these entities has its own employees and its own fixed assets, but in addition, the taxable entity ends up having some employees and fixed assets that are shared with the non-taxable entity, Entity 2. So now let's again look at the situation. In this situation, the taxable entity ended up determining that the cost of the shared employees and shared assets that were used by the non-taxable entity were about $27.5 million. The IRS ended up coming in this situation with a transfer pricing economist and tried to assess additional taxes of about $1.2 million by increasing the intercompany charge by about $3.5 million. Now, the logic the IRS economist used in making that adjustment was to give the taxable entity an operating margin of 14.2%, which it determined was consistent with the profitability of a sample of third-party for-profit lab testing service providers. Fortunately, in this example, this group kept exceptionally detailed records and calculations of the intercompany charges and was able to get a no-change conclusion to this audit. So they saved the potential tax of $1.2 million in this case. Now, the final example, the first two examples, you note that there were multiple legal entities within the same group. They just happened to be within the same jurisdiction. Here's a situation where we have a single entity not-for-profit organization, and this entity's mission is to provide education and employment services to people with disabilities, to whom the organization refers as their clients, okay? Now, in addition to providing those education and employment services to clients, again, the people with disabilities, this organization also employs some of its clients in some taxable business activities that generate unrelated business income. For example, they provide laundry services and janitorial services and some minor packaging and assembly services. So here we see that a look at the functions performed by the back office administrative staff resulted in $2.2 million of the $3 million of SG&A costs being allocated from the non-taxable activities to the taxable activities. Like in our first example, that charge effectively shifted unused or wasted deductions from the tax-exempt activities to the taxable activities where they can be used to reduce the amount of income that's subject to tax. As a result, this organization ended up achieving tax savings of about $770,000, which it was able to put straight into funding its programs that are directly related to its mission of helping the disabled. So hopefully those examples drive home what we're talking about here, and you can see at least some applicability in your situations, in your organization's situation. So now it's time for our third of our 4 polling questions. Our question this time is, what types of transactions does your organization have that could possibly raise transfer pricing issues? Are they cost allocations like we just went through, including interest and rent? Are they actual bona fide transactions of interest, rents, or royalties? Are there related party services other than these indirect cost allocations or sales of inventory or other tangible property like equipment? Are there 2 or more of the above, none of the above, or not applicable because you're Moss Adams, or otherwise not applicable? So I'll give you about 15 more seconds to click the answer. Remember, click the button next to your answer and be sure to choose Submit at the bottom right. And you need to, just a reminder, you need to answer 3 of these 4 polling questions to get your CPE credit. All right, just 2 more seconds here. Okay, let's close the poll, and here are the answers. Okay, so there are a good number of cost allocations. Quite a few of you have at least 2 of these situations, which is great. So you are seeing some applicability to your situation. All right, Darren, back to you for some talk about documentation.
All right, thanks, Paul. And as we can see, there was various situations and a wide range of situations where cost allocations and transfer pricing affect NFPs. Now, obviously, one of the ways in planning and taking the opportunity to cost allocate, one has to document the transaction. So there is really a wide variety of general definition of transfer pricing documentation, but to the strict definition and according to the IRS, transfer pricing documentation must follow the 10 elements as set out in principal documentation in Section 482. And it consists of 3 broad categories: functional analysis, best method analysis, and economic analysis. So in the first, in the category functional analysis, essentially what happens is in a document, we would determine what are the functions, assets, and risks of each entity to the transaction. So that would be discussing what each related party does. And then we would go through a process of looking at all the methods, and I had mentioned in my previous slide around selecting a best method. So the document itself would actually go through the methods and say why we have chosen a particular method as the best method. And then the third would be all the numbers, and then determining what is the actual transfer price or the range of prices that we feel is arm's length following the principles set out in 482. So it's highly recommended that there is always some sort of documentation put in place, even if it's a memo to file to say that this is why you've chosen a method. But in situations where there is a higher threshold and the potential for penalties, so there is actually a penalty of 20 or 40%. If you have documentation, then those penalties go away. It doesn't necessarily protect you from a income adjustment, because the IRS can always make an assessment and state that you should have a higher level of income for a taxable entity. However, the documentation itself will reduce the penalties, and in many cases, that penalty can be in the hundreds of thousands. So therefore, documentation would obviously make sense. Now, once you have this documentation, it's a good idea, to put in place, because if the IRS requests it, a taxpayer has 30 days to present documentation to the IRS, and having it in place, it usually answers a lot of questions and removes a lot of the hassle in terms of going through individual invoices and going through policy documents. So if you have something in place prior to being reviewed, then it's a good idea. In order for a documentation to be contemporaneous, it has to be done prior to the submission of the tax return. So when something's considered contemporaneous, it has to be done often for taxable. It's September 15. I believe this year is October 15, and it may be different depending on the year end of your entity. And now, there's also other documentation that must be considered. Obviously, we want to know what the taxable status of each entity, the trade or purpose, what transfer pricing was done, and then also there are other tax filings that one must keep up with 5471, Form 8858, and the new Form 8975, which is country-by-country reporting, which Paul will cover in the next slide. Paul?
Okay, thanks, Darren. I do just want to quickly touch on the IRS's new Form 8975. This form came about as a result of the G20 OECD initiative known as base erosion and profit shifting. You may have seen some articles about this in the press. The acronym that's being used around is BEPS, B-E-P-S, again for base erosion and profit shifting. As a result of the OECD G20 initiative, many countries are now requiring multinational businesses to submit what's known as a country-by-country report. Form 8975 is the IRS's version of that. It's required to be submitted with tax returns for years beginning on or after July 1st, 2016, and must be filed by the U.S. entity that's the multinational group's so-called ultimate parent entity. U.S.-based multinational groups are exempt from filing this new form if the group's global revenues, so consolidated worldwide revenues for the prior year, were less than $850 million. So well, I guess to point out, the IRS has limited the definition of revenue for most not-for-profit organizations for these purposes to include only those revenues included in unrelated business taxable income, UBTI. So we think that it's highly unusual for a not-for-profit organization to have UBTI in excess of $850 million, so this would hopefully not apply to too many of you out there, but it is still something you need to be aware of because you may end up having to be filing a similar form in any foreign countries where you have operations. Part of the reason for that is we don't know, in most foreign countries, there is not a definition, a lot of guidance as to what they determine as revenue. So you may have a line on your P&L that is over $850 million globally, but in terms of your UBTI, your revenue is significantly below that for U.S. purposes. But the foreign country may not respect that UBTI limitation, and because you have that line item on your P&L that is over $850 million, this may be applicable to you. It's also worth pointing out that the foreign country, well, the U.S. Form 8975, as I said, is required for years beginning on or after July 1st, 2016. In most foreign jurisdictions that have adopted a country-by-country report so far, they are required for years beginning on or after January 1st, 2016. So there's a whole year lag potentially for calendar year entities. So it's conceivable that you may have to file a country-by-country report in a foreign country, even if you're not required to file this IRS Form 8975. So we just want to caution you on that. So, Sasha, you're on to talk about the accounting requirements.
Yes, great. Thank you, Paul. So we'll shift gears from a tax perspective, and we will now take a look at a few items from a GAAP perspective for a few minutes. I realize many of you, if not all, have heard about ASU 2016-14 by now, but for those maybe who aren't as familiar, ASU 2016-14 is a new standard issued last year on the presentation of GAAP financial statements, and we will discuss some of the high-level changes from this ASU, being sure to highlight the specific changes related to functional expenses and how that ties into today's presentation. The goal of ASU 2016-14 was to try and bring clarity to some items and also create some consistencies between the various not-for-profit financial statements. Due to the wide range of types of not-for-profit entities, it was noted that a lot of times there was quite a difference in the way certain information was being presented. And so one of the goals was to try and align some of that information. They also wanted to try and align not-for-profit financial statements more with those from the for-profit sector. And so to accomplish some of these goals, some of the things that were done to kind of accomplish this was to improve the current net asset classification requirements, which we will touch on the next slide, improve information in financial statements and notes specific to liquidity, cash flow, and financial performance. And as I mentioned previously, to have more consistency between the not-for-profit and for-profit external and internal reporting. And they wanted to align comparability within the various industry groups and recognizing that, I think that got jumped ahead for a moment, recognizing that a lot of times many of the users of not-for-profit financial statements do come from a for-profit background, and so really trying to make those financial statements more readable to those users. They also thought some of these changes would allow not-for-profits to better tell their story to the public. So ASU 2016-14, this ASU project has been undertaken in 2 phases. Phase 1, which is effective for fiscal years beginning after December 15th, 2017, is what we'll cover today. And then Phase 2 is sometime in the future, an untimed future at the moment. So one thing to note is that early adoption of this standard is allowed, but I want to caution everybody that if you do elect to early adopt this standard, you need to make sure that you're adopting all provisions of the standard. Since there are multiple pieces to this Phase 1, you unfortunately do not get the benefit of hand selecting which pieces you would like to early adopt and which you would like to wait and adopt after the effective deadline. So one thing to consider when thinking about the potential of early adopting this standard. So some of the components of Phase 1 was combining temporarily and permanently restricted net assets. So formally, there had been 3 classes of net assets: unrestricted, temporarily restricted, and permanently restricted. And now under this new standard, it takes us from those 3 classes down to 2. There will now be net assets with donor restrictions and net assets without donor restrictions. The hope is to kind of clarify the different types of net assets that sit with an organization. Related to the statement of cash flow, there has always been the option to present the indirect or the direct method for your statement of cash flow. And that option will still be available, but now one of the changes that is done is in the past, under the old guidance, when you presented the direct method, you were also required to show the indirect method reconciliation of the operating activities. Under this new standard, it removes that requirement to have that duplicative information of also showing the indirect piece of the operating section of the statement of cash flows. And the hope is really to try and reduce extra work for something that is really providing duplicative information. There will also be some requirements related to enhanced disclosures specific to amounts and purposes of governing board designations, the composition of net assets with the donor restrictions, and then how the restrictions affect the use of the resources in the future. Liquidity, disclosing quantitative as well as qualitative information. and then methods used to allocate costs among program and support functions, providing a little bit more clarity in how that allocation is actually happening. And then related to underwater endowment funds, no longer those will be unrestricted, but there will be some enhanced policy disclosures related to that. Expense classification and presentation. So there's a couple of slides following this that really highlight what the old guidance was and what the new guidance now requires. But a couple of other items just on this slide related to the last areas of Phase 1 are related to the reporting of investment return. You'll now report that net of related expenses on the face of the statement, and there will no longer be a require to disclose the actual amount of the expenses that are being netted on the face of the statement. And then lastly, a requirement to use placed in service approach, which eliminates the overtime approach for expirations of restricted long-lived assets. Okay, so let's dive into the GAAP specifics of the functional expense presentation. Under the old guidance, the statement of functional expenses was only required for voluntary health and welfare organizations. These organizations were required to show the functional expenses in a separate statement as part of the financial statement reporting package. Other organizations not considered voluntary health and welfare organizations were still required to somehow present and or disclose what the functional expenses were in total. However, they didn't have that requirement to actually have a separate statement to present that information. They had the choice of either presenting it summarized on the face of the statement of activities or somehow disclosed in the notes to the financial statements, or in some cases, some type of supplemental schedule. Now, with the new requirements from ASU 2016-14, all entities, regardless of voluntary health and welfare or type, will be required to show expenses by both natural, and getting back to what Chauna said, that relates to the type, so payroll, rent, accounting, other. So they'll be required to show expenses by both the natural category as well as the functional category. So your management in general, your program, and your fundraising. Now, what is neat about this standard is that it does provide the opportunity for the not-for-profit organization to choose how they are going to disclose that information. It doesn't necessarily have to be in a separate statement to the financial statements, like a statement of functional expenses as was required for voluntary health and welfare organizations in the past. That is still an option. However, you also can decide to incorporate that somehow into the face of the statement of activities, in the notes to the financial statements, or maybe even some other kind of supplemental schedule or presentation. So that is something for organizations to start thinking about, really paying attention to what will readers of the financial statements, how will they want to interpret and use that information, and what makes the most sense in order to communicate that information. So we have our final polling question, which you want to make sure and answer. And as everyone has mentioned, you need to get 3 of the 4 polling questions so that you get your CPE credits. So the final question is, do the changes in the ASU 2016-14 affect your organization? And I'm curious to see the results of this. 1, yes, it's on our to-do list. Yes, we're already in the process of reviewing our activities to shore up documentation. No additional work needed. We've already identified and appropriately documented activities and expenses. Not sure, and I don't think this is applicable to me. So we'll go ahead and take about 30 seconds, make sure everyone logs their answers, and then we'll see where we land. All right, we'll give everyone about 10 more seconds. Let's go ahead and advance and see what we've got. Oh, so actually a good variety. but it does look like the majority, which is good, have identified that this is applicable and it is on the to-do list, so it's definitely on your radar, which is great to hear. And then some have already even started on the process, and then some are kind of still thinking about it, so a good variety. Well, that concludes our presentation materials for today's webcast. However, we have left time here in the last 10 minutes to answer any specific questions that you guys might have on the information that was presented today or related to the information. So I'm going to go ahead and turn it over to Emily, who will lead us through the Q&A time.
Awesome. Thanks, Sasha. As a reminder, if you have a question, you can submit that in the Q&A window, which is to the left of these slides here. And our first question is, if an organization goes through the facilities and administration rate process, is the negotiated rate acceptable to use to allocate indirect costs to UBI activities of a single entity? And then there's a second part, would the negotiation documentation suffice?
Yeah, I can answer that question, and I think yes, and I think it can serve as support for an allocation. So ideally, once you've gone through the negotiation process, I would recommend that you put a memo around that and say this was the process. So we went through a negotiation process, and then we've allocated our indirect cost to UBI activities for this single entity based on this negotiated rate. So to put some context around it and put that to file. What we're trying to avoid would be if the IRS came in or the state revenue authority came in and said, well, I agree you have a negotiated rate, but when did you apply this? And obviously you would want to apply it prior or have some support prior to a review rather than subsequently. Paul, do you have any further comments on that?
No, I think you're absolutely right there. And the key is, as the question alludes to, the documentation. You want to make sure that you have the negotiation documented, and you also want to make sure that you document how you are following what was negotiated. In other words, you don't want to have a negotiation that says the answer should be this, and then have your actual allocations be something different. We did get another question about our examples that I went through, so I'll take that. Chauna, I'm going to ask you to chime in here. I'm going to go back to the slides with the examples. Question came through as to how these examples translate to the 990s and other tax reporting issues. Can you talk about that a little bit with this first example?
Absolutely. So for the first example, if we assume the same facts, but instead if they are not separate legal entities, and that the unrelated activities, the golf course and the hotel, are just ancillary to the organization, if we look at the next slide, if we look at this slide and show the example on top, if we look at it before transfer pricing, the only profit that was being generated was from unrelated activities. This means that the only profit is substantial, and this can cause the loss of the tax-exempt status of the organization because the actual mission is not generating any income, but the ancillary activities that are unrelated would be actually creating more income. But if we do go through the second, down at the bottom of the slide, through transfer pricing, you can see that with the shift of the expenses, the exempt profit is now $1,100 and the taxable income goes down. So this shows that the exempt purpose profit is greater and there's a less substantial profit from the unrelated activities, which should help shield the organizations.
Okay. Do you have anything else to add, Emily? Chauna, on these other examples?
Sure. For this example, I just wanted to note that where the IRS had come back and actually tried to change the amount of costs that were being allocated, it's important to know that there is no period of limitation on assessments for the IRS, so they can go back as far as they want if they feel that there was a false or fraudulent return filed that was purposely to evade tax. So that's something to note. Also, if 25% or more of the gross income was omitted, then the IRS can go back for 6 years. So it's really important to make sure that we're using reasonable allocations and that they're documented so that the normal statute of limitations would apply. And for the third example,
Sorry, go ahead. I didn't realize you were...
It's okay. This is something we actually see very commonly with a lot of our nonprofits. I think a lot of times we see debt finance rental activities. So it would be the same thing if the taxable activities were handled by a separate entity. A lot of times a not-for-profit has additional office space or resources that they can rent out to for-profit organizations. And it's really important that they use transfer pricing and make sure that costs related to building, maintenance, operations, and everything can be used to offset the unrelated business income aspect, since they are not in the business of renting real estate, and so it would be considered unrelated. Okay, Emily, back to you.
Great, thank you. And we have had several more questions come in. Let's go with, if our private foundation is not audited and doesn't have an external audience for GAAP financial statements, how much effort should be made to comply with the new expense allocation requirements?
I can discuss that from an audit perspective. So really the requirements in ASU 2016-14 are specific to presentation of financial statements, so external financial statements that are compliant with GAAP. So technically, if you are not having a GAAP financial statement audit performed, then you wouldn't necessarily need to be compliant with that from an external perspective. However, I do like to always caution that you do not know maybe if that requirement will ever change and whether or not you want to have the controls and processes already established to be able to track that information, or if you're going to have board members or others who are going to expect to still see that information for board reporting packages or other internal reasoning.
And from a tax perspective and a transfer pricing perspective, I think you need to understand that it's just like any other line item on your tax return, if you will. So the level of documentation should be based upon a prudent business person's decision as to how much exposure you feel you have. Obviously, we don't know the magnitude of your situation and how big the allocations are relative to your overall organization. But you do want to make sure that there is at least some support for the numbers you're using in terms of these allocations from a tax returns perspective. Emily, do we have time for one more question?
Yeah, we sure do. Let's go with, do you have a good definition for direct donor benefit expense, and how should this be presented on the functional expense allocation statement?
Chauna or Sasha?
I can take that from a tax perspective. So if we're talking about, from what I can assume we're talking about, direct donor benefit expense for fundraising events, that would be actually not shown on the functional expense statement because that would be shown net on the statement of revenue. So for Form 990 purposes, it's a little bit different because we do have that difference where the expense is on the expense statement for financial statement purposes, but it is lumped in with fundraising events and on the statement of revenue for Form 990 purposes. I don't know, Sasha, if you wanted to touch on the audit side.
I don't have anything else to add to that, Chauna. Thank you.
All right. Well, that looks like all the questions that we have time for today. If we didn't have time to address your question, we will follow up with you after the webcast. And I'd like to thank today's speakers, Chauna, Darren, Paul, and Sasha, for a great presentation. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window to the left of the slide view. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will be emailed within 2 weeks should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.